You check your phone and your jaw drops. Mortgage rates just jumped overnight, or maybe they dropped, but your neighbor got a different rate than you. And you start wondering, what actually moves mortgage rates? Is it the Fed, inflation, or some secret only lenders know? What's up, everyone? I'm Brand the Mortgage Man. Over the last 23 years, I've helped more than 10,000 families realize their dream of homeownership. And today, we're diving deep into mortgage rates, what really moves them, what myths you need to ignore, and how you can use this knowledge to get the best possible rate. If you've ever been confused by rates, you're not alone. And by the end of this video, you'll finally understand what drives your mortgage payment up or down and what you can actually control. Let's start simple. A mortgage rate is the interest you pay on your loan each year. It's expressed as a percentage, like 6% or 7%, but it's not random. Your rate is based on two things: the cost of lending money and your personal profile. The cost of lending money is driven by broader economic forces. Your personal profile includes your credit score, your down payment, your debt to income ratio, and your loan type. Think of it like buying insurance. The safer you look to the lender, the cheaper your premium. In this case, your rates. So let's kill some big myths. Myth number one: the Fed sets my mortgage rate. False. The Federal Reserve does not directly set mortgage rates. They influence short-term rates like credit cards and personal loans. But your 30-year fixed mortgage, that's tied to the 10-year Treasury yield, not the Fed's rate. Myth number two: rates move predictably. That's wrong. Mortgage rates move daily based on bond markets, inflation expectations, and investor sentiment. Myth number three: all lenders offer the same rate. Nope. Different lenders have different pricing, overhead, and risk tolerance. Two lenders can quote a 6.25% and a 6.5% to the same borrower, and that difference matters. Understanding these myths keeps you from chasing the so-called perfect day. So what actually moves mortgage rates? There are four main drivers. Number one, the bond market. Most fixed rate mortgages are sold on the secondary market. Lenders sell loans to investors, and those investors watch the 10-year Treasury. When yields go up, mortgage rates usually rise. When yields go down, rates typically fall. Number two, inflation. Inflation is the silent killer for rates. Higher inflation, investors demand higher returns, and rates go up. Lower inflation, rates can drop. Even small inflation changes can move your rate by a quarter point or more. Number three, economic data. Job reports, GDP growth, wage increases. Strong data signals a strong economy. Investors expect inflation, rates will rise. Weak data, investors move to safety, rates can fall. Number four, global events. Yes, what happens overseas matters. Geopolitical conflict, stock market volatility, foreign demand for U.S. bonds. Mortgage rates are global, not local. Now let's talk about what doesn't move your rate. The Fed hiking rates does not automatically move mortgages. There's no magic day of the week, and your local bank manager doesn't decide your rate. Your rate comes from secondary market pricing, not vibes, not timing luck. Here's the good news: even when markets are crazy, there are things you can control. Your credit score, 780 plus, you're going to get the best pricing. 700 to 740, you'll get good pricing. 620 to 699, the rates will be a little bit higher. Your down payment, more down, less risk, lower rate. Less down, higher rate, plus PMI. Your debt to income ratio, lower DTI, lower risk. Higher DTI, higher rates. Your loan type, 30-year fixed, standard. 15-year fixed, lower rates. ARMs, lower initial rates. And points. Buying points can lower your rate. It costs more upfront, but can save you thousands if planned correctly. So, should you lock or should you float? Locking guarantees your rate for 30 to 60 days. Floating leaves you exposed to market movement. Generally, lock when rates are rising or unpredictable. Consider floating only if you understand the risk. You can't time the market, but you can control your preparedness. Here's another big one: you should shop lenders. Even when rates look the same, lenders differ in closing costs, points, fees, and more important than that, service. I've seen buyers assume 6.25 is cheaper than 6.5 until they compare the real cost. Let's bust the last big myth: you need perfect timing. Truth? Focus on credit, down payment, and lender. ARMs are always risky. Truth? They can be strategic. You can always refinance. The truth is, refinancing has costs and rules. Plan ahead. Here's your action plan. Check your credit, know your down payment, get pre-approved with 2 or 3 lenders. Choose fixed or ARM. Use points only if long-term. Lock when the rate fits your goals. This is how you stay in control instead of reacting to panic. Mortgage rates can feel confusing, and honestly, they are. But when you focus on what you can control, credit, down payment, loan type, and lender selection, you can still get an excellent rate. Ignore the noise. Ignore social media panic. Build a strategy based on control, not prediction. If you want more videos breaking this down simply, subscribe and turn on notifications. I'm Brand the Mortgage Man, and I'll see you in the next one.